Good afternoon, and thank you for joining us for a fourth in a series of AlabamaWorks live webinars dealing with Alabama's workforce response during the COVID-19 pandemic. Past episodes are available on our website at alabamaworks.com. And now, Tim McCartney, Chairman of the Alabama Workforce Council.
We're pleased to have you with us again for our fourth week during the pandemic we're all experiencing. We appreciate you being with us, and we hope we're providing you some very important information that will help you deal from a business standpoint with how to best deal with this virus. Today, we have some very, very exciting speakers that we've had with us that will bring you some very important information. We have 5 speakers, and actually 4 speakers, and I will introduce them one at a time, and then at the end I'll come back in and wrap it up for the day. But we're certainly very pleased and honored to have for our first guest today the current president and CEO of the Federal Reserve Bank of Atlanta, Dr. Raphael Bostic. Dr. Bostic was appointed as the 15th president of the Federal Reserve Bank of Atlanta in 2017. And prior to being named president, Dr. Bostic was a professor of public policy at the University of Southern California. He has a wealth of experience from an outstanding career in academia, government, and research. Dr. Bostic has served as Assistant Secretary for Policy and Development Research at the Department of Housing and Urban Development. He has a passion for understanding the housing sector and how credit markets, financing, and public policy work together to help people achieve the American dream. He's particularly interested in working with policymakers and researchers to discover ways to improve economic mobility and resilience and to make the economy work for all Americans. Dr. Bostic is leading the Atlanta Fed's efforts to promote safety and payments innovation, which includes partnering with financial technology companies in the 6th District of the Federal Reserve. He is, Dr. Bostic earned his undergraduate degree from Harvard University and his PhD in economics from Stanford. During Dr. Bostic's tenure in the Atlanta Fed, he's traveled extensively throughout the Southeast to meet with different business leaders, both from nonprofit and profit organizations, academics, students, and other elected officials to better understand how the regional economies work within the 6th District. And he brings those insights with him to the monetary policy table in Washington, D.C. So that's great to have him do that. So without further ado, I want to welcome Dr. Raphael Bostic to our 4th Alabama Workforce Council Recovery webinar. Dr. Bostic.
Thanks, Tim. Technology. Thanks, Tim. It's really good to be here. I want to say good afternoon to everyone. It's a pleasure to be able to speak to you and give you some sense and an understanding of how the Federal Reserve is approaching the crisis and give you a picture of how I'm thinking about it. To start, I thought it would be useful to just give you the larger context, which is that what we're going through right now is quite different than any kind of economic slowdown that we've had, certainly in my lifetime and probably for the last 100 or so years, in that it's a public health issue. This is a challenge that is driven by issues around the broad public health of the United States and of all of our communities. And in that sense, it's very different than the typical slowdown, which is associated with increases in risky behavior and concentrations of risk that then turn into significant losses and exposures to particular companies. This is really different than that in the sense that the economy was operating in a very strong, solid way. We had an extended period of growth, and really there was not a lot of excessive risk taking that was taking place. And so in thinking about what the response should be and what our policy approach needs to be, it's really different than the typical strategy of needing to stimulate the economy to stop the retrenchment that has arisen because of elevated risk levels. This is really about trying to create a bridge so that we go from that pre-virus era when we had a very strong economy to get to the post-virus era, and hopefully to preserve all the fundamentals that had made us strong before the virus and that post period, so that we can just jumpstart back into the economy the way it was operating before. So if you think about all the things that the Fed has done, and in fact, both on the fiscal side as well, they really have been with an eye toward trying to keep things as normalized as possible to make sure the financial markets operate in a significant way and in a stable way, but also to make sure that businesses and families are able to deal with their cash flow difficulties that are associated with the response to the pandemic and really create that bridge. So most of our facilities are designed to give short-term support to businesses, to banking institutions, to financial institutions, and to those in the marketplace, so that they can weather the storm and move forward. So that's a sort of a larger picture in terms of the philosophy. Now, in terms of what we're doing specifically, at the very beginning, what we saw was at the outset of the crisis, basic financial markets had stopped functioning. So the treasury market has stopped functioning, and some of the more foundational markets, such as a mortgage market. And so our very first actions were to provide extra liquidity into those markets to make sure that people did not face excessive costs to get access to credit and capital, but rather could operate in a more basic and fundamental way. And since we put those facilities in place, what we've seen is credit spreads narrow considerably and get close to sort of more normal situations. We also saw that funding for corporate credit and credit was struggling as well, and that the markets there weren't working as well. And so we provided some liquidity to the primary and secondary corporate credit markets for investment grade businesses, because those businesses use those capital markets as the primary way that they get access to their operating capital and their investment capital. From there, we saw stresses in municipal markets. So we developed a money market facility that was designed to provide support for investors for short-term government bonds to make sure that the public sector was able to fund themselves. And since then, I think just a couple of days ago, we announced a slate of new facilities that are really designed to provide additional liquidity support. We have one that expanded our support for corporates to extend liquidity to what we might think of as fallen angels. So investment grade companies that have fallen out of investment grade, but only because of the shutdowns associated with the crisis. We wanted to acknowledge that their loss of credit quality was not caused by anything they had done, but was really driven by an exogenous event. We announced that we were providing some liquidity backstops for the Paycheck Protection Program. And I'm sure you all know that's a program that is being run through the SBA and SBA certified lenders to get operating capital to small businesses, SBA eligible businesses. I think you have an SBA speaker on today, so there'll be more on that. And then we also announced the term sheets, or release of term sheets associated with the Main Street Lending Program. And that's supposed to provide support, short-term lending support to businesses that are just above the SBA limit, so that those businesses can also get either new credit or have their existing lines of credit extended to be more supportive. And then we also announced that we had provided a new facility to actually outright buy municipal bonds for some of the larger jurisdictions across the country and the 50 states. So that's a broad level of support. And the thing to note in our actions there has been that we have continued to monitor the market. And as we've seen markets or segments of the market where there are stresses, we've tried as much as possible to, if there was a vehicle or a way for us to support it, to get that support out there as quickly and as dramatically as possible. And on that point, one of the things we learned in the Great Recession was that the Fed is most effective when it acts early and it acts aggressively to to attack weaknesses. And so we've really tried to do that. And I think by any historic standard, the responses of the Federal Reserve to this crisis have been strong, and they've been early, and they've been definitive. And I think the message that we're really trying to send there is that we are monitoring, we're on the case, we're going to do whatever it takes to make sure that the parts of the economy that we can influence remain robust, so that they're in the best possible condition when we get to the backside of this crisis. And there's one more thing I wanted to say in terms of the things that we're doing, and that is we are talking with financial institutions, with the banks that we regulate, and we are strongly encouraging them to work with their customers to participate in the programs that are available, to make sure that those businesses are able to minimize the stresses and the burdens that they're facing. So we're asking banks to work to restructure more loans that they might have with businesses and with families. We're looking really for them to deploy every dollar of capital they have into the market to support these bridging exercises. And we really want them to be a partner. And the message that we've sent at the Federal Reserve is that we understand these are exceptional times, and we want you to take extraordinary actions, and you will not be penalized for them down the road. So for those of you who have existing relationships with banks, I would encourage you to go talk to your banker if you haven't already, and see what kind of things might be done in terms of either extending the term of the loan, deferring payments, deferring interest, lots of different ways to restructure. I would encourage you to do that to help you bridge and keep as many of your employees on the rolls as possible. So that's a very quick, brief summary of the things that we're doing. I think the biggest message for us to you is, we're on the case, and we're going to make sure that we do all that we can so that the disruption that's happening now does not become a permanent hindrance to our ability to do business, and that we have as many businesses on the backside as possible relative to where we started. So let me stop there, and let me say just one other thing. And I have two slides that I'd like to just have put up. And those two slides give you a way to keep in touch and track the things that we're doing. We have a lot of expertise at the bank, and I rely on my staff a lot, and we're trying to get that information out as much as possible. So if you text to that number, or you follow us on Twitter, you can follow me on Twitter. It's just at my name, Raphael Bostic. You will be able to keep up to date with the things that we're doing. And I would also say, subscribe to us. We have lots of tools that are useful to give you a sense of what's going on. So I want to thank you again for your time and your attention. And I guess I'll turn it back to Tim for questions.
Well, thank you, Dr. Bostic. That was very, very interesting. And I want to thank you so much for taking the time out. I know you've got a very, very busy schedule normally, but particularly during this time.
Yeah,
so,
there's a few things going on.
Yes, I can imagine. Chris, our moderator, is going to ask some questions to you. I think we've got 4 or 5 questions, if you don't mind hanging on for that.
Sure.
So, Chris.
Dr. Bostic, the first question is, what is keeping you up at night right now?
So right now, I think the biggest thing that keeps me up at night is the question of how we're responding to the public health crisis. To my mind, we won't get back to a more normal economy until the regular rank and file population is not afraid that they're going to get infected if they go to the store, or if they go to a ball game, or if they go to their place of work. So we really have to make progress on that, and we have to start to see responsible behavior that helps us collectively minimize its spread. That's the thing I'm most concerned about. And then the second thing I would say is I worry that people might be losing hope, that they see all this disruption and are not feeling that the support that we're trying to get to them is as close as it might actually be, and that they don't reach out and try to do the things to get them that support. So that's one of the reasons why I'm trying to get out and talk to as many people as possible to let them know what's out there, so that they don't let opportunities go by the wayside.
Okay, the next question. Does the Federal Reserve expect an extended period of monetary easing, just like from 2008 to 2016? or a shorter period of monetary easing, a V-shaped recovery?
So I guess what I would say is I don't really look that far out into the future. I really try to take things on a month-to-month basis or a week-to-week basis. If we wind up in a V-shaped recovery, I think the chair has been clear, and I agree with him that once we're back to normal, we're going to take all these emergency things away and let the economy stand on its own. But we'll let the economy tell us what the appropriate pace of a normalization looks like. So if it takes longer, then we'll be in a more eased position for a longer period of time. But if it's shorter, then we won't. And that all goes back to really what the public health response looks like. The sooner we can get all of our communities to the peak and past that, so that we start to get into a more stabilized environment in terms of the prevalence and the spread of the virus, the sooner we will get back to that normal economic level of activity, and we can get off of our maximum stimulus emergency stance.
All right. Our next question is, what do you anticipate will be the short, medium, and long-term effects of this crisis?
Well, I'm hoping that in the short run, we're going to have some disruption. I'm hopeful that the support that's out there can mitigate some of that. But this is giving people a lot of stress. There's a lot of uncertainty in the marketplace. And I think there's just going to be a lot of nervousness for the next bit. In terms of the medium to long term, I think that's a really interesting question. We at our bank and through the system, we went on work from home on March 13th. So we've been out. This is our 5th week out. And we are learning how we can actually get work done in a different way using technology, not necessarily having to be in meetings. And I'm expecting that many businesses who are out there are going to start thinking differently about what a business model looks like, what it needs, what they need from their workforce, and what kind of things we might allow the workforce to do. Our bank has not really been a big work from home place. But we're finding we can get work done. And so I think that's going to be interesting. And I'll be curious to see the transformations moving forward and how we do our business and what business models people feel comfortable pursuing.
The next question is, some people are saying that the Fed's policy moves will A, ultimately come from taxpayers, and B, ultimately will add to the national debt. Is there any sense in which either of these is correct?
Well, it depends. So, in the Great Recession, we did a lot of support for businesses, and almost all those businesses paid back all the money. And so in that sense, those were investments that were paid off. In this instance, we got the same question. So, does the extending of loans to businesses above the SBA limit lead to losses, significant losses? The time will tell, and we'll have to see. I guess what I would say is, that's down the road. Right now, we have short-run crisis considerations that we have to take into heart or take to heart. And I want to make sure that the history books don't say we missed some short-run opportunities to provide support because we were looking too far down the road. I want to make sure that we are on top of everything in the short run. And then when we get to the long run, we'll have to figure out a strategy. But if the short run doesn't work well, the long run is going to be a whole lot worse. So I'm really focused on the short and the immediate response to make sure that we have a less daunting task ahead of us when we get to the long run.
This is our last and final question. Why didn't the quantitative easing from the last recession cause a higher inflation rate? And how do you think the current infusion of capital into the financial system will impact the inflation rate in the United States in the next year?
So this is it's a very good question, and it's a source of debate among economists. So the neutral rate of interest, which is really a foundational driver of what inflation is going to look like, has been falling in the United States for the better part of 30 years. And it's not well understood why that's happened. But because of that, as time has passed, there's been increasing downward pressure on inflation rates. And I think that secular dynamic is what's kept inflation from being significant. I've not seen any evidence to suggest that dynamic has changed in the last 2 or 3 years, or even the last 6 months. So I'm not expecting that we're going to see explosive growth in inflation. And in fact, the developments in the oil sector are pushing in the other direction. So I think that for the immediate term and for the next little bit, I think inflation is not going to be our biggest concern. And I'd be pretty surprised if we started to see runaway inflation in the next 6 to 12 months.
Okay, well, Dr. Bostic, very, very interesting comments. And again, we appreciate your time. I know it's very valuable and you've got a lot to do. So we appreciate you being with us and we'll welcome you back anytime that you can. So with that, we'll move on to our next speaker, who is, I think this is his third time on our 3 out of 4. So it's our Secretary of Labor, Fitzgerald Washington, and he's going to update everyone on what else is going on as far as the Department of Labor is concerned for the response to the COVID-19, particularly on an update on the unemployment compensation, which I think some of that money has finally hit in Alabama, has it not, Secretary?
It has, and good evening. And thank you, Mr. Chairman, for allowing me to come back again to update everybody on what ADOL is doing to provide resources for the people in our state. The CARES Act that President Trump signed has 3 distinct programs of relief. So I'm going to cover with you the 3 key programs underneath the act, and then also talk about some relief that's associated with each one of the programs. One of the areas all states have been challenged with is the fact that the federal government has been really, really slow with giving state guidance on how the programs in the CARES Act should be administered. So the first program I'll talk about is the Pandemic Unemployment Assistance Program, or PUA. This program provides unemployment benefits to those not originally eligible for them. These include individuals that are self-employed, nonprofits, gig economy workers, churches, or contract employees. These groups do not contribute to the state UI trust fund, but needed a pathway on how they should apply for those benefits. Today, ADOL released more information on how these groups can apply for benefits. We have those detailed instructions listed on our website, which is labor.alabama.gov, on how to file. Alabamians who file for benefits may receive a notice that they are ineligible for benefits, even though they may still be eligible. All claimants will receive a document in the mail, and a document should be completed with the required documentation as soon as possible for the claims to be processed. In the instructions, self-employed Alabamans are to enter your name as their employer and use that address or business address in the profile box. Self-employed individuals will need to file weekly claims for each week or partial week they are employed. We will be able to pay all those eligible weeks retroactively. The second program is the Federal Pandemic Unemployment Compensation Program, or FPUC. This program provides $600 per week to an individual eligible for unemployment compensation. So again, you have some people that will qualify for the maximum $275 unemployment compensation weekly benefit and the $600 stimulus benefit, which totals $875 per week. Now, for comparisons, in the state of Texas, their maximum unemployment compensation weekly benefit amount is $521. And so when you add the $600 weekly stimulus, you're at $1,121 per week. You must know that Alabama was one of 5 states that pulled the trigger on paying the stimulus once we received federal guidance. And the final program in the CARES Act provisions is the Pandemic Emergency Unemployment Compensation Program, or PEUC, which allows for an additional 13 weeks of benefits added to the end of the regular unemployment benefits. Now, what that means is claimants may collect unemployment benefits for a longer period of time than under normal circumstances. Now, let me take you through a few scenarios and benefits. So let's just say if you are an employee with reduced hours or wages, including hourly and tip employees, or have been furloughed and will be returning to your job, then you could be eligible for 14 weeks of regular benefits. You also might be eligible for the $600 stimulus up to 13 weeks. Let's just say if you are an employee that's been laid off permanently with no intentions of returning to your job, you could be eligible for 14 weeks of benefits and also the $600 weekly stimulus. If an employee has exhausted all their regular unemployment benefits, you could be eligible for the $600 a week stimulus, because your regular unemployment benefit has already been paid. And as mentioned, if you are a part-time worker, self-employed, or an independent contractor, a 1099 worker, church employee, nonprofit or government employee, gig economy worker, and those who have exhausted their regular benefits, you can qualify for up to 39 weeks of expanded benefits. You also may be eligible for the $600 weekly stimulus. What if you're what if you are the primary caregiver, responsible for a child or a person who is unable to attend school or another facility as a result of COVID? You could be eligible too for 39 weeks of expanded benefits and the $600 weekly benefit amount. And what if you quit your job because of COVID-19? You could be also eligible for 39 weeks of expanded benefits and the $600 weekly stimulus. Now I'm going to shift gears just a little bit and give you an update on some facts regarding initial claim filings through our agency. There were 73,000 claims taken last week alone, approximately 98,000 claims filed the prior week, and 20,000 claims filed just yesterday. So as you can see, claims are going through our agency, and we're taking them as rapidly and as quickly as we possibly can. There's been more than 264,000 claims filed in the last 4 weeks, compared to 130,000 claims filed all of 2019. That's more than 100,000 claims increase if you look at the same time period. ADOL has paid out over $150 million in claims over the same time period, and $91 million in stimulus relief since last Wednesday. And currently we have almost $700 million in our UI trust fund to pay out the claims. Just as a reminder, payments will be made to direct deposit accounts or ADOL issued debit cards. It may take up to 21 days, but in some cases it could come sooner. Direct deposit is the fastest method to receive the benefits, as the debit cards will add an additional 5 to 7 days before payments can be made. Now, as we've moved through this pandemic, our agency has made what we call some necessary improvements that I'll also share. We've moved our UI claimant portal to a cloud-based system, which has sped the frequency for claim filers. We've already seen a vast improvement by doing so. We've also made changes to our partial filings or mass filing system. Before, employers, when filing on behalf of their employees, had to list each individual name before submission. Now these employers would just send us one file spreadsheet, and we will export those files into our system. Something that I'm really excited about is the rollout of our new unemployment claims tracker, where the person can track their claims from initial filing and get constant updates on their claim until the benefits will arrive. We're still testing it. My hope is that we'll pull the trigger on the unemployment claims tracker sometime between now and tomorrow. So stay tuned on further details on it. We've also repurposed 150 Career Center essential staff personnel to assist with the surge of calls we're receiving. And then finally, we've interviewed 4 outside call center vendors to help us take calls, and we should have a decision on that process by this week. We see these enhancements as major improvements for both the employer and the claim filers. Again, we realize there's a lot of tension out there for those who've been laid off, and the process has been slow, but people are getting paid based on completed claims that they file. So we just ask you to continue. We ask that you continue to have patience as we continue to improve our processes. So that's my update for this week.
Well, thank you, Secretary Washington. We appreciate that. And I know it's a continually moving target. And hopefully we'll get these unemployment claims down as quickly as we get back to work. We just got to be diligent in fighting off the virus and doing what the health officials tell us to do. Our next speaker today is a returning panelist, Mr. Michael Brooks from the Small Business Development Center out of Tuscaloosa. Michael was with us last week, and we were just getting into the SBA loans, and I think you've had some pretty good updates for us this week. So I'll turn it over to you, Michael.
Yeah, certainly. And thank you again, Tim, for the invitation to return and share the updates that we have on these various small business programs. I'll start with a quick plug since we've got Dr. Bostic on the line. The Federal Reserve does they're a source of incredible information for business leaders, our elected officials, et cetera. And so while this is 6 months, 6.5 months away, there's a small business credit survey that the Federal Reserve Bank deploys, usually in the October, November, December timeframe. As a user of the data, it's a golden set of information. And I would just say, try to add that to the back of your mind. About 6 months from now, look for a survey from the Federal Reserve Bank where they've partnered with the SBDC programs around the country to help deploy that and get the survey in front of small businesses, especially now with this seismic economic upheaval. Information directly from the market is even more valuable than ever before. So just a quick plug there. You know, the SBC program, the reason that we're around and our mission, our goal, we're creating possibilities for prosperity for one of the state's most important economic contributors. That's our small businesses. According to SBA stats, there's about 400,000 in the state, and they account for 47% of the state's population, 47% of the state's employment. And right now, our goal in helping companies, small businesses survive in these difficult times and in these stormy days, literally stormy days, we hope to be able to help them thrive on the sunny and clear days. And I think I join everyone in hoping that we can have just one disaster at a time. And we're glad that the damage caused by the weekend storms were not any worse than what we did experience. That said, the hurricane season is right around the corner, so keep disaster plans fresh and nearby. So the SBC program, you know, we're interested in working with every single small business that we can. Our goal is to provide access to professional business advisors located throughout the state and provide some unbiased and confidential feedback and guidance to them. Obviously, the last several weeks have been a challenge, and like many of the resources out there have been strained by the volume. We're in the triage process and we're quickly moving through those and trying to get questions answered. One of the challenges that we've had is that these disaster loan programs that were deployed have been a bit of a moving target, where guidance from Treasury on Tuesday evening was updated by SBA on Thursday evening and deployed differently. It caused some confusion and then frustration. And then one of the challenges we have right now is, as companies are still in the application process for these programs, they may be making decisions with slightly dated material that was correct at the time that was deployed, but at this point, the numbers have changed. And we're just advising folks to always go back to the source, make sure you're dealing with the most recent information when applying for making decisions for your business. Really just have two short updates on the primary programs. The first on the SBA Economic Injury Disaster Loan Program. And there are two components to that. One of them on the forgivable up to $10,000 forgivable advance, and then the disaster loan itself. And as many small business owners will recall, when the program was initially launched, it was mentioned that that initial forgivable advance would be available within 3 days. And 3 days quickly turned into 14 days. The good news is that those forgivable advances are now rolling out. And we've been asking clients for documentation so that the SBC program can understand how it's being deployed so we can provide better guidance to folks that are still in the pipeline. We did have confirmation from SBA last week that the up to $10,000 advance is based on employees. It's $1,000 per employee, up to 10 employees. So we're a handful of small business owners that might have employed 5 full-time folks. They were expecting $10,000. And when the forgivable advance came through, it was only at $5,000. And that there was some confusion around that, but SBA has clarified $1,000 per employee up to the first 10. There were several news reports on Friday and Saturday that there was an additional limit on the disaster loan where it was being capped at $15,000 total because there was not adequate funding for that program to deploy it nationwide. And SBA has denied that. And we have evidence from companies that we've been working with that have received disaster loans for $200,000 and $300,000 based on their application. So the $15,000 limit may have been a cautionary statement at some point, but the reality at this point is SBA is funding the disaster loan applications based on the calculation that they use. And the calculation for disaster loans is basically your annual sales minus your annual cost of goods, divide by 12 times 4, up to $300,000. Anything below $300,000, and SBA will very quickly, almost instantly process that when your application gets to that point of processing in the queue. And we have had a few companies that we're working with that get very pleasant surprises because it's not every day that you open your online cash register, your banking account there, and see a deposit directly from U.S. Treasury. And it's tagged as SBAD, Small Business Administration Disaster, with U.S. Treasury after it. So we have confirmation that the forgivable advances are going out and that the disaster loans are going out. It was a rough start to the program, but we're very happy to see, and the companies we work with are very happy to see those funds are flowing. And as a quick reminder for companies that applied under the initial disaster loan application, we call it version 1 or version 2, the temporary one. Official guidance from SBA is that you should go back and make sure that you're applying through the current application portal. So if you submit an application to SBA before March 30th, SBA is telling folks to go ahead and submit an application through the new portal to ensure that your application is processed. So that was the disaster loan. A quick update on the Paycheck Protection Program, PPP. As you can imagine, when eligible lenders started taking applications a week ago, it was a tidal wave. My brother is in banking, and we've got several other folks that we work with. That is the most often used expression, a phenomenal tidal wave of applications that came in. And they are in the process of working through that, and we are excited to see that those PPP applications are being processed, funds are being dispersed, and companies have started the 8-week timing, the 8-week clock on how they can use those funds to pay for payroll and other allowable expenses. We, at this point, are recommending to businesses to spend additional time on record keeping. Once your 8-week clock starts, at the end of those 8 weeks, you're going to need to go back to the lender that issued this loan and have the evidence and have the proof documentation that shows that you deployed the funds in compliance with the regulations of the program. And if you have sloppy paperwork, bad record keeping, it's going to be an awkward conversation with your lender. Now, this program we have heard is, I'm not sure we could say running low on funds, but there is a limit to the amount of funds that are available. And as far as where the current amount is, you'd have to check with today's news articles to see where we're at today. But the applications, what we've seen so far, we are moving quickly through it. And we understand that our friends in DC are working on additional legislation to provide additional capital for these programs. Last I heard is we probably should not expect that until the end of the month at the earliest. And let's see, final note on the paycheck program. When it first rolled out, many of the larger banks started their own online application portal, and some of the smaller ones were accepting paper applications and doing manual entry. One of the challenges that some of the small businesses ran into was their lender was not participating in the program. They had not participated in SBA loan product before. They were not already approved. And the existing banks, lenders that were participating were only serving their customers. You can understand from the lender's point of view, this is a high effort, low yield type of product for them. And they want to be able to serve their own customers first as a value add service. Some of them will accept applications from non-customers, but that's going to be on a one-by-one basis and usually requires a phone call and possibly a visit to a branch to connect with them. We have over the weekend identified a variety of other lenders that are accepting applications from non-customers, folks that are currently not banking with them. In Alabama, and these are not endorsements, but they're just provided as public service, as places to check. We have heard that Trustmark and United Bank are accepting applications from non-customers. And then we've heard varying stories, it may vary by branch, but that you can try to apply and create a business account at Renaissance, Community Bank, Progress Bank, First Southern, Center State, and we've heard different things on Synovus and Bryant Bank. In addition to your local lenders, we've also heard there's some online lenders, the folks in the fintech field, Intuit, the folks that create QuickBooks have an online portal, Lendio, Bowfly, Cabbage, Lendistry, PayPal, and Fundera are all online options. Again, not an endorsement, but we've heard that they are accepting applications in case that is a need. And I'll just conclude, if you have any small businesses that have questions on these programs, feel free to reach out to us, asbc.org, and we'll be glad to get you in touch with one of the folks in our capital access program that will help walk you through these applications and help you through this disaster. Again, thanks, Tim.
Thank you, Michael. Great information. I know that's a program that I'm getting questioned about all the time, and I'm directing them to you and also to this webinar. Great information, though. Thank you so much. Our next speaker will be a friend of mine, Cleve Poole, who is a fellow board member of the AWC, but he's also the chair of the Structure and Alignment Committee for the AWC. And within that Structure and Alignment Committee is the Alabama Committee on Credentialing and Career Pathways, which is a big program we're working on. And Cleve's put a lot of his time into creating the credentials and some career pathway steps for our current students and adults that are looking to get these credentials and careers started in high demand, high wage jobs. So Cleve, bring us up to date on that and what's going on there.
Thanks, Tim, for the opportunity to chat a bit about our continued that we have a workforce that is prepared for the high demand jobs that are going to be out there when the restrictions are finally lifted from this COVID-19 pandemic. As Tim said, I'm Cleve Poole. I'm Vice President of Economic Development and Legal Affairs for Pioneer Electric Cooperative in Greenville, Alabama. I serve on the Alabama Workforce Council and am chair of the Structure and Alignment Committee, which oversees the Alabama Committee on Credentials and Career Pathways. We call that the ACCCP. The ACCCP was created last year by the Alabama legislature. It's tasked with identifying the in-demand jobs in each workforce region in Alabama, as well as the skills that make up each job. And once all that work has been accomplished, we'll work with educators in our state, K-12 and the post-secondary systems, to make sure that they're teaching the skills needed for those jobs so that our supply of workers meets our demand of workers. In addition, online resources are being built that will make it easy for workers to identify their training requirements for their dream jobs. And it will make it really easy for industry HR professionals to sift through their employment applications to find the right fit for open positions by matching skills with jobs. Now, the work we've done to date confirms what we all know. There are basic skills that are universally needed for any job or profession. I call it work ethics. It's also called work skills, life skills, but these skills form the foundation for all jobs. And we have to make sure these skills are universally taught and learned beginning in kindergarten and throughout the entire formal education process. We continue to urge K-12 and post-secondary to embed these teachable skills into their curriculum. We believe that one of the outcomes of this shutdown will be a clamoring by many workers to be better trained. In other words, they need to be ready in case something like this ever happens again, to be less expendable for the job they're in at the time. So they need to be ready to, they will need to get additional training so that they can get more or better jobs. The ACCC and its subcommittees, we've been on a hiatus during the last month, as many of us have. We've been trying to figure out social distancing and Zoom and hand washing, but it's time we get back to work. In the next couple of weeks, we'll resume our efforts, most probably through Zoom or some other technology, to identify the in-demand jobs. And of course, there'll be new in-demand jobs, or the jobs will be slightly different once the economy restarts. And we'll complete our work in identifying the skills needed for those jobs and have identified where those skills can be found and learned. Moody's Rating Service recently announced they thought Alabama would come out of the virus shutdown in a pretty good shape. So that means that Governor Ivey's goal of 500,000 workers with additional in-demand credentials by 2025 is still our goal. That's because that's what Alabama industries are going to need. Ultimately, it's our job to make sure that folks have the training to do the job for which they aspire, and that industry has the workers for the jobs that need to be done. It's that simple and that complicated. So, Tim, I appreciate the opportunity to chat today, and I'll turn it back over to you.
Thanks, Cleve. Great report. Good job. That's a very, very important program, and it is a very, very hard program to put into effect. A lot of hard work with a lot of people working on that. Our last speaker today will be someone who's a regular, is Nick Moore from the Governor's Office of Education and Workforce Transformation, or as we call him, the GOAT. So Nick, the floor is yours.
Thank you, Mr. Chairman. I want to take a moment to especially thank our guest, Dr. Bostic, who has been an exceptional partner to the state throughout the COVID-19 pandemic and before, in our work with Ms. Cornegay and the Birmingham branch, and Dr. Reuter and his work to help us stress test our sector is going to be particularly useful, to the point that Mr. Poole made about our occupations maybe looking slightly different post-COVID, but be able to have a pulse of what that looks like and to have some empirical data to back it up is very important. And thanks to all of the panelists that have been on here today. I've worked very closely with many of you, Mr. Poole and Secretary Washington, and getting to know Mr. Brooks more and more as we were on more of these panels together. But I wanted to spend just 1 or 2 minutes giving you some updates about our COVID-19 workforce response survey. We have had a very good response so far, 549 respondents as of today. We would like to have one more push on that. So if you could please try to get us up to 1,000, we'd like to have that. We're seeing a lot of our respondents in just a few counties, actually. So we want to make this statistically significant statewide. So we need to see more responses throughout the state. Just a couple of highlights is that over half of our respondents thus far have been small businesses with 1 to 25 employees, and that's is good that we're getting a good pulse of our small business community. About a third of businesses that have responded are mainly hourly, have mainly hourly employees, 75% or more hourly workers. So we are getting a good mix of businesses that are small and have a lot of hourly workers. We've seen a correlation between those that have a small number of employees, particularly those that are hourly employees, and a stronger prevalence of layoffs for such folks, as they're just a little bit more exposed. The top 5 industries we've seen responses from is manufacturing, healthcare, accommodation, and what we call other services, and then retail trade. Other services, just kind of a catch-all that excludes public administration. 44% of the businesses reported that their current business climate is bad. However, just about half also said that they expected their business climate to improve in the next 6 months. So that's positive. About 47% expect that their workforce will remain pretty constant over the next 3 months, which is also, I guess you could take it as either good or bad news, and that perhaps maybe some feel that they would not remain constant. Also, about half felt that they were somewhat equipped to handle COVID-19. So we've seen a lot of 50-50 answers here. An overwhelming majority, about 76%, expect the pandemic to have a negative financial impact on their business, which is not good news, but it's probably to be expected. A little over a quarter have laid off employees as a result of the pandemic. Now, as I mentioned, those that had 76 to 100% hourly workers were almost twice as likely to have laid off employees, and respondents who indicated they were not equipped to handle the COVID-19 outbreak at its onset were nearly twice as likely to also have laid off employees. So about 53% are planning on a hiring freeze during the pandemic. And also, if they said that they were going to delay training, the employer-delivered skills-based training was the type that most likely would be delayed. 76% mentioned that they don't feel like they will need help delivering or developing training, and 49% indicated that after the pandemic that they do plan on doing a lot more skills-based training, and they think that would benefit their company. So I think that's something we should keep in mind. There were a good variety of folks that are different fears or worries, but most of those that were reported were delays due to economic recovery, business closure, duration of the pandemic, and long-term macroeconomic malaise, trouble paying bills, cash flow issues, as we would expect. So that's the highlights of the survey. I would say the bottom line on it is a lot of these results are tend towards what you would expect. Those businesses that are in public-facing sectors are going to be a little bit more exposed, and those that have fewer employees and also and hourly employees tend to be a little bit more exposed to the short-term consequences. So we'll continue to update these results as we get them in, but over the next week, if you could help us get up to 1,000 respondents or more, we would certainly appreciate it. Thank you, Mr. Chairman.
Thank you, Nick. Great report. Just in closing, I want to thank our speakers again, Dr. Bostic from the Federal Reserve Bank in Atlanta. We're thrilled to have him with us today. Great report. Michael Brooks from the Small Business Development Center in Tuscaloosa. Thank you, Michael. Great information, very helpful. Fitzgerald Washington, Secretary of Labor. I don't know if Fitz still on the line, but always good to hear from him and what's going on over in the Labor Department. And Cleve Poole from the AWC Structural Alignment Committee. Cleve, thank you for all the hard work and taking time out of your day, because I know you're busy down there in Greenville working hard. So, and then Nick, of course, from the governor's office. Thank you very much for your time. I know you've been a little busy the last few weeks, night and day. So our next meeting next webinar we'll have is next Tuesday, back at our normally scheduled, what we've been scheduling around 4 o'clock. This webinar was recorded, so you can go to the AlabamaWorks.com website to see a version of it, and it's also helpful to go back and you can see the specific parts that you may want to go back and listen to again. So be using that. Also, the survey that Nick's talking about is on the AlabamaWorks website. So please, if you haven't filled out that survey yet, do that. It's very helpful. It helps us in the state formulate the plans for improving our workforce and what we need to do. So that's very important information. It's not going to be thrown in the trash can, trust me. Finally, I'd like to thank our AIDT group that put this on. They're behind the scenes. We've got Chris doing the moderating, and Jill Corbin and her group, and Sonia out there. I hadn't seen Sonia's face yet, but I know she's there. And thank y'all for all y'all's hard work keeping this program going. So until next week, y'all have it. Play safe, stay safe, do your social distances, and stay well. Thank you.